Diversification is the most important concept in investing that almost nobody learns properly. Most beginner videos repeat, "Don't put all your eggs in one basket and call it a day." This video shows the actual math, real examples of what happens when you ignore it, and exactly how many investments you need to be truly diversified. Here's the math you really need to internalize. Roughly 30% of all individual stocks in the US market eventually go to zero, meaning the company goes bankrupt or collapses entirely within a 20-year window. Owning a single stock for the long term is closer to a coin flip than an investment. Compare that to the S&P 500. Over any 20-year period in modern history, it has never lost money. Same time horizon, wildly different risk. So what does diversification actually mean? It's spreading your money across many investments instead of concentrating in one or two. The mathematical magic is this: when you own 20 different stocks instead of one, your risk drops by roughly half, but your expected return stays the same. That's right, same return, half the risk. In finance, this is called the only free lunch that actually exists. Every other form of risk reduction comes at the cost of return. Diversification is the exception. Some real examples of what all-in on one stock actually looks like. Enron, at one point one of the most respected energy companies in America. The stock collapsed from around $90 to zero in about a year after the company's accounting fraud was exposed. Lehman Brothers, a 150-year-old investment bank. Stock went from around $86 to worthless during the 2008 financial crisis. Silicon Valley Bank, a major tech-focused bank. The stock dropped from $267 to zero within days during the 2023 banking crisis. And 23andMe, once a $6 billion company, filed for bankruptcy in 2025. These weren't tiny obscure penny stocks. These were household name large companies. Concentration risk is real, even with great companies. Here's the visualization that should change how you think about investing. The x-axis is the number of stocks in your portfolio. The y-axis is the portfolio's volatility, basically how much it swings up and down. With one stock, you're at about 30% annual volatility. Add 4 more stocks for a total of 5. Volatility drops to 22. Get to 20 stocks. Volatility is around 15%. That's about half the risk of owning one stock. Add another 300 stocks to get to over 500. Volatility barely moves below 13%. The big takeaway: most of the diversification benefit is reached at 20 to 30 stocks. The S&P 500 gives you 500. Owning a basic S&P 500 index fund instantly puts you near the bottom of this curve, at the lowest risk. True diversification has 4 dimensions, not just one. Most people think diversification means owning more than one company. That's the first level, and the most basic. But you can own 20 stocks and still be poorly diversified if they're all in the same sector. The second dimension is sectors. Don't put all your money in tech, or all in finance, or all in energy. The third dimension is geography. Owning all US stocks ignores 40% of the global economy. International and emerging markets diversify differently. The fourth dimension is asset class. Stocks, bonds, real estate, commodities. Each behaves differently in different economies. Real diversification spans all 4. A single low-cost index fund covering global stocks gets you most of the way. So how many stocks do you actually need? Academic research is consistent on this. Most of the diversification benefit kicks in at 20 to 30 stocks, after which adding more provides diminishing returns. The S&P 500 contains 500 companies, so buying a single S&P 500 index fund gets you 15 to 25 times more diversification than the bare minimum. For most beginners, one broad index fund is more diversification than they'll ever practically need. 3 myths to clear up before you go. Myth 1. I own 5 stocks, I'm diversified. Probably not. 5 stocks gets you most of the way to the diversification benefit, but not all of it. And 5 stocks all in tech is concentrated, not diversified. Myth 2. I'll just pick the next Apple. Most beginners assume they can identify which one stock will be the next decade-defining winner. Academic research is brutally consistent on this. Almost no one does, including professionals. Myth 3. Owning the S&P 500 alone is full diversification. It's excellent diversification within US large-cap stocks, but it doesn't cover international stocks, small caps, bonds, or real estate. For deeper diversification, add an international fund or a total bond market fund alongside it. Diversification is the only free lunch in investing. Same expected return, much lower risk. The simplest way to capture it is one broad market index fund. Don't bet on one stock. Don't try to find the next apple. Buy the haystack, not the needle. Time and diversification do most of the work.